Silver prices down a bit today, but that's after 8 days of gains. Let's get more from Daniel Ghali, Director and Commodities Strategist at TD Securities. Daniel, thanks very much indeed for joining us as ever.
Yeah, thanks for having me.
Walk us through, you say there has been a supply squeeze in silver. Can you remind us what happened?
Sure, absolutely. I mean, listen, Andy, at the start of this year, I sat across from you at that very table and argued for a silver squeeze you can buy into. Mm-hmm. And the premise was that a flow of metal, a tidal wave of metal was moving from London into the United States, incentivized by U.S. tariff policy. Mm-hmm. And the implication was going to be significant because we were going to drain London inventories, which set global benchmark prices below levels that are sustainable for the market structure. This has now occurred over the course of October. Silver prices have rallied, nearly 100% year to date, and the market is finally turning bullish. But we think the setup has changed now, and in fact, this seems to us like we are setting up for a blow-off top in silver right now.
Oh, you mean so a blow-off top would be a sharp decline in silver, Daniel?
Eventually a sharp decline, yes. We think there's really only a few weeks remaining in which this kind of extreme volatile price action can remain, but ultimately the setup has changed.
Sorry, go on, Daniel.
Yeah, the London inventory data has completely improved, and in turn, silver prices no longer need to trade substantially higher and no longer need to sustain these levels.
So is this partly because of the move of precious metals and copper into the U.S. market in anticipation of tariffs, and that is now reverting to normal?
Yeah, I mean, silver has been 5 years into a structural deficit, so we were always going to end up in this point of time. But that theme has accelerated drain out of London inventories until the moment where silver markets were squeezed. Right. Ultimately, this is a function of the fact that global inventory systems across critical minerals markets have actually fragmented over the course of this year, which means that, although a year ago you might have been satisfied holding physical silver in London, in Shanghai, in New York, and today that's no longer the case. You actually need the physical metal in the right jurisdiction. That is really what catalyzed the squeeze, but the squeeze itself has incentivized London inventories to replenish. Right? Shanghai has emerged as a backstop to London inventory pools. New York has emerged as a backstop to London inventory pools. London inventories themselves are now at the highest levels since silver traded $25 an ounce lower. So clearly, we no longer need this to be the case. And in fact, I think the most bearish development has actually been some evidence that private vaults, which reportedly hold a very significant amount of silver off of exchanges, and scrap have now come back into silver markets.
Okay, so you are warning speculators this silver ride may well not last very long. Talk to us about copper as well. Now, we have a chart showing global copper inventories. They are high, but you're talking about fragmentation of inventories. We know that countries are stockpiling frantically, for example. So inventories look like they've been growing, certainly in some jurisdictions, including the COMEX. But that doesn't mean the world is glutted with copper?
Yeah, and I'm so glad you brought up this chart because it really is the case in point, right? Global visible inventories in copper markets have risen. So are we concerned about a surplus? We should be able to absorb that surplus with global visible inventories. Well, the issue is that inventories that now arrive into the United States are landlocked from the rest of the world. And most of the time, that the same is true out of China. And what that really means is that throughout this fragmentation process, or as a result of it, global inventory pools, namely the London Metals Exchange, for example, or in the case of precious metals would be the London Bullion Market Association, those global inventory pools are easily drained, but they're not easily repleted. And we know that, or we have high certainty in copper markets that for the next 6 months, that will continue to be the case. This is an extremely powerful microstructure that should exacerbate the tailwinds we expect from macro themes.
So the world has become kind of balkanized, hasn't it, in terms of commodity markets with all this strategic stockpiling?
Yeah, I mean, the way we look at it is the world is actually inching closer towards a wartime economy.
Wow.
And really, to be specific about that, what we're talking about is that governments are incentivizing or prioritizing industrial production in some cases and stockpiling in other cases. This is the case because they fear China's dominance in critical minerals and in processing of those critical minerals, and in turn want to secure their supply chains. But in doing so, they're actually creating this rush to stockpile. It's resulting in a fragmentation of inventory systems, and the net impact, again, is bullish for most of these critical minerals.
Daniel, thank you very much indeed. Really appreciate it.
Thank you, Andy.
Daniel Ghali, Director and Commodity Strategist at TD Securities.